The conference. We have a long day ahead of us. So dinner was great, yes? The company was great, that's for sure. I'm just going to see a couple more seconds. So out on the tables are sign-in sheets. Please print your name, sign in, and sign out. So you have two signatures, okay? So you'll see it being passed along this way and passed along this way. Okay, make sure I collect it. Because again, we might offer firm element on this after we review the slides and after compliance takes a look at it. If we do, we'll make sure you get recorded on your Reg Ed, so you don't have to worry about that. That's kind of nice. So again, sign in and sign out, and then just move the paperwork all the way across. That would be great. First up, we have a new sponsor, Ascendant Capital. So I contacted them probably January, somewhere around January or so, and again, talked about NPB, who we were, asked them a little bit about them. Seemed like a perfect match, which was fantastic. So obviously I said, hey, do you want to come in and talk to our group and sponsor the conference? And they said, yeah, we would love it. And then after finding a little bit more, I said, hey, it'd be great if you could come up here and be a keynote speaker and start the conference off. And obviously they're very happy to do so. So I want to thank Ascendant Capital for coming out and meeting with us, as well as sponsoring the event. After this, we have the one-on-one meetings, which will go right next door. Remember, I'll be watching every single one of you guys, so make sure you guys hit the booths. Remember, the time slots are behind your name badges, and then I'll go ahead and call everybody, and then we'll rotate, and we'll keep doing this for a while, and then come back in for another session. So, with that in mind, I'm going to go ahead and give the floor to Jordan from Ascendant Capital. Thank you very much.
All right. Thank you. Thanks, Frank. Thanks, everyone. Thanks for having us. As Frank mentioned, my name's Jordan Kahn. I'm the Chief Investment Officer at Ascendant Capital Management. And today, we're going to try to help answer the question, does this bull market still have legs? But first, let me see by a show of hands, how many people in the room think that we've already seen the highs this year in the market so far? Just a couple. How many people think that the market's still going to go on to make new highs at some point this year? Okay. Okay. All right, good. Well, let's get into it and see if we can confirm, everybody's thoughts and biases. So the first question that we hear a lot of recently is, does the recent volatility that we've seen in the market, does that kind of mean that the bull market's over, right? That things are coming to an end? And what we would say is that actually, the recent volatility that we've seen in the market is probably more normal than it is abnormal, right? What was really abnormal was the extreme low volatility that we saw last year in 2017. So if you look at this long-term chart, you can see that in 2017, the peak drawdown in the market from top to bottom during the course of the entire year was only 3%, right? Which is extremely low. This chart goes back about 40 years, and you'll see there was only one other instance back in '95, where we saw that little volatility, right? So really, it's kind of an outlier for there to be such low volatility during a year. And what we know from the tendency of markets to show mean reversion is that periods of low volatility are often followed by periods of higher volatility, right? So the fact that we had a year with such low volatility just meant that it was more likely that we were going to see increased volatility as we came into this year. And the market was really overdue for the kind of 10% correction that we had. It had been since early 2016 since we had seen a pullback of that nature, right? We're also getting into the later innings of this cycle. You have the Fed raising interest rates, and so all those things kind of augur for investors to be prepared for a little bit more volatility. Okay? The other thing is, what about valuations, right? People always say, well, the market seems fully valued, doesn't really seem like it can move higher from here. And so we like to look at forward PEs of the market when we're talking about valuation. And what you can see on this chart is that right now the market's trading at about 16.5 times forward earnings, which is really in line with about the 25-year average. Okay? So not really overvalued, probably still some room for multiple expansion if we do get a return of the so-called animal spirits at some point this year. And with earnings estimates moving higher, in a couple months, analysts are going to be talking about the forward estimates for 2019. Right now, the S&P is expected to earn about $172 for 2019. So that would make the PE about 15.5 times next year's earnings, which really isn't overvalued in terms of historical norms. But the last thing is valuations in and of itself aren't really a great timing tool, right? It's not like when you reach a certain valuation, that means it's time to get out. Markets can get fully valued and then get overvalued, very easily. So we're going to talk about some other things that may help us in terms of timing things better. But let's look at some of the positive factors for the market that I was mentioning. One of the biggest positive factors that we have going on right now has been the strong earnings growth in the market. So with this chart, the solid line is the S&P 500, and the dotted line are the forward earnings estimates for the market. And what you can see is a year like last year, where we had that steady rise that I was talking about, it was really accompanied in lockstep by a steady rise in the underlying earnings, right? So last year's strong market performance wasn't just a result of multiple expansion. It really was a result of this strong underlying fundamentals, and ultimately it's earnings growth that propels stock prices higher. If you look at what happened here in the beginning of this year in January, when you see this sharp spike higher, what's interesting is that it was also accompanied by a sharp spike higher in the underlying earnings estimates. And what was happening there was that the tax cuts that were passed, right? Tax cuts provide a big boost to earnings estimates, and there was this delayed reaction before the tax cuts started to get priced in. So for a long time last year, even though the tax cuts were being talked about, they weren't really getting priced into the earnings estimates. And once they were actually passed into law, we saw the analysts scrambling to revise their estimates higher, hence this big ramp, and the market had its own ramp as well. What's also interesting is that since that has happened, if you look at the far right side here, you see that earnings estimates, despite the market coming down, earnings estimates have continued to drift higher. So we continue to have this strong tailwind for the market in the form of very strong earnings growth. Okay. What about consumer confidence? This is something that we also look at as it relates to the economy, because we know that in our economy, consumer spending makes up a little more than 2/3 of GDP growth, right? So it's important to look at something like consumer confidence. And in the most recent report from the Conference Board, consumer confidence actually hit its highest level since the year 2000. So we're seeing tremendous consumer confidence. Additionally, the income expectations component of that report hit its highest level since 2001. So you have tremendously strong consumer confidence. You have a lot of confidence in terms of income expectations, and those things bode well for strong consumer spending in the near term, which should continue to boost the economy. Another interesting data point that came out of this report was that plans to buy a new home surged to a record high. Now think about that for a second. We're talking about a record high in plans to buy a new home, even above what was seen during the housing bubble. So that really caught my attention and kind of struck me as odd. They didn't really get into any explanations for it. One of the best things that I could glean from it is probably the fact that when you talk about the millennial generation, right, and how big that generation is by demographics, what was often said about it was that there was this delay with the millennials in terms of when they got out of college, they couldn't find jobs right away. A lot of them moved back home with their parents. But I think now, as a lot of millennials are feeling more confident about their job prospects and things like that, they may be the ones that are help driving this plans to buy a new home higher. And then lastly, one of the research outfits that we subscribe to is Ned Davis Research. They do a really good job of tracking and forecasting coming recessions. And right now, their latest report said that their index that forecasts recessions is currently at quote-unquote extremely low levels. So that's important. And the reason why we kind of pay attention and try to track this things about recessions is that I talked about how important earnings growth is for this market, right? And usually, in order to have a big rollover in earnings, you need to have something like an economic recession. You know, things don't just really roll over on their own without being accompanied by a recession. And in terms of talking about any bear market or looking at past bear markets, you know, most bear markets, unless there's some sort of geopolitical event, most bear markets are accompanied by a recession. So that's why we always track these things. And right now, it doesn't look like there's one on, at least on the horizon for the near term. All right, let's look at another asset class. And this is a chart of the CRB commodity index. And what's important about this index is that commodities tend to be very highly cyclical, right? So they're very economically sensitive. And so right now, if the economy was on the precipice of rolling over and weakening, what we would expect to see is the CRB index rolling over. You can see back in 2015, the commodity index was showing a lot of weakness. That was the time when GDP was softening here in the US, when China was slowing down. But since then, we've really kind of had this 2.5-year sideways consolidation, and just recently, we're starting to see a breakout on the upside. So that's kind of a signal from the commodities market that you know, it's really pricing in more reflation to come in the near future than it is pricing in economic weakness. All right. Now I'm going to get into a little bit about sentiment indicators. And so this is also something that we track to try to get a gauge of how investors feel about the market, right? How bullish or bearish current sentiment is. And the first thing that we're going to look at is fund flows. I know that this data on here is kind of small, and I think Frank said that he can provide copies to anybody that wants to see it. But I'll highlight it for you. And so what we're looking at here is tracking the fund flows, right? Money that's coming into the market from investors, and whether those fund flows are flowing into stock funds, which generally means that people are feeling more bullish, or whether they're flowing into bond funds, which usually means people are feeling slightly less bullish. And so what we see here for the last couple of years is in 2016, there was outflows from equity funds and strong inflows into bond funds. Okay? So that makes sense. But what about last year? Even last year, when we talked about that strong, steady year in the market, the S&P was up 18%, very low volatility. Even in a year like last year, there was $186 billion that flowed into equity funds, but more than twice that amount flowed into bond funds. And we've seen the same thing so far this year. Small inflows into stock funds, but more than twice as much has flowed into bond funds. So over the last roughly 2.5 years, bond funds have taken in almost 5 times as much fund flows as equities. So there really hasn't been much enthusiasm for stocks in terms of fund flows.
What's the historical average? Is it like equal or twice as much stock?
So it's cyclical. There's really no historical average, but what tends to happen is as you get into bull markets and investors feel more confident about the prospect for stocks, then fund flows start to be much higher into stock funds, right? When the stock market rolls over and people get nervous, then that's when you start to see more fund flows into bond funds, okay?
Is there a difference between domestic purchases and foreign purchases in either one of those sides?
They do break it out. So for my purposes, I was just using the total here. But when you get this thing later, you can look at it. It breaks it out into domestic and world and ETFs and mutual funds and that sort of thing.
On the bond side more so.
On the bond side, it's the same thing. The categories are broken out the same thing, domestic and world, and then the bond funds are broken out between taxable and tax-free. So bond investors in recent years have obviously enjoyed this tailwind of lower interest rates, right? It's been a really good investment for years. This year, now we're starting to finally see interest rates reverse and move higher, and so it's possible that some of the bond investors who aren't used to seeing negative numbers on their statements, you know, as things like that start to come in, we could see a reversal in flows and some investors start to reallocate out of bond funds and back to equity funds. So that's something we'll just have to watch for. Another thing that we track are the investor surveys, right? And so these are weekly polls that question different groups of investors to try to get a gauge of how bullish or bearish they are. And so what we do here is we look at a cross-section of these to represent different investor classes. So the Investors Intelligence Survey, this is a survey of newsletter writers where they ask them how bullish or bearish they are. And what we look at is the spread between the number of people, the number of bulls, and the number of bears. And so recently we saw that this bull-bear spread was the lowest it's been since November of 2016. Now that time frame is important because that was the time frame that was leading up to the election, right? There was a lot of uncertainty going into the election, and hence, we saw a lot of bearishness or uneasiness in the market. The AAII survey, this is a survey of individual investors, so it tends to show a little bit more volatility, but again here, similar. Recent readings, the spread between bulls and bears hitting 2-year lows. Market vein, this is a survey of professional futures traders. Okay, and again, for this survey, they only asked them how bullish they are. And recently, we saw that the bullish percentage in the market vein survey, again, lowest level since November of 2016. The NAAIM, this is a survey of active investment managers. Same thing, how bullish or bearish are these investment managers? Sentiment there recently hit its lowest level since February of 2016. That was the last time, you may recall, that the market had a 10% correction. We saw a lot of bearishness coming out at that time. And then the last one, this is the Fear and Greed Index. This is an index that's tracked on the CNN Money website, and it tracks about 7 different, these are market-based indicators, things like stock market breadth, performance of riskier high-yield bonds versus safe haven bonds, market volatility, things like that. And I have a chart here. You see that this Fear and Greed Index recently hit its lowest levels, going all the way back to the summer of 2015. That was the time when China did that surprise yuan devaluation and the market fell about 10% in a matter of days. So again, you've seen a lot of bearishness amongst these investor surveys. And why it's important to try to gauge that is that you've all heard that saying that a bull market loves to climb a wall of worry, right? So when you see this pervasive bearishness amongst the surveys, it tells us that wall of worry is still standing firmly, right? And that the bull market can continue to climb that. What you don't want to see here is when the market starts to show weakness and you have a correction, for there just to be a lot of complacency, right? If none of the investor surveys were showing any sort of worry, that would be a bigger red flag for us. So the fact that you do have this large amount of bearishness amongst these different asset classes historically has been a good sign that it helps the market to put in a bottom at some point and work its way higher. They're weekly, so we've been tracking these surveys on a weekly basis for years. All of these things, when I say that it recently hit it, within the last 2 to 3 weeks. So not necessarily last week, but just as the market was having its most recent pullback. Okay. Another thing that we look at, right, it's one thing to track what investors are saying, right, in terms of how they're answering polls. It's another thing to look at what they're actually doing with real money, right? So what are portfolio managers doing within their funds? And one of the things that we look at here is the options market, specifically the put-call ratio, right? And so this measures how much protective put buying is going on or how much hedging is going on in portfolios in real time. And so the put-call ratio tends to be fairly volatile on a day-to-day basis. We smooth it out a little bit by looking at a 10-day moving average. And what you see here is that a couple weeks ago, the 10-day moving average in the put-call ratio hit its 3rd highest reading in the last 5 years. So again, you're seeing a confirmation in the options market similar to what we're seeing amongst the investor surveys. Okay, and for those of you that have ever managed portfolios that may have had put options in it, I can tell you from real life experience that when the market starts to rally and you have these put options in your portfolio, they can act like a dead weight, keeping you from participating in the rally, right? And so what tends to happen is performance anxiety sets in. The market's rallying, your portfolio is not participating, you're worried about your performance, you're worried about what your clients are going to say, you're worried about what your boss might say, is it going to impact your bonus, all these sort of things, right? And so what ultimately happens? Ultimately, you can't take the pain anymore. You say, I got to get rid of these puts, and you rush to sell them and get rid of them, right? So when investors are rushing to buy puts, that puts downward pressure on the market. Conversely, when investors rush to sell their puts, it adds upward pressure to the market. So it's almost kind of like throwing gas on the fire during a market rally. So at some point, if we do start to see the market rally again, all of this protective puts that are on portfolio managers' trading sheets, let's call it, could exert some upward pressure to things.
Very consistent volatility. Is there a time of the week or a time of the month where you tend to buy a lot? Is that why it's so consistent with everything else?
No, I mean, it's a daily. It really just depends on market conditions, right? When markets start to break down, that's when you tend to see more put buying. It really spikes when the market's making lows, that sort of thing. So we kind of look at a band, right? Between 90 and 1 is kind of a normal band of volatility. When it breaks above 1, that's really a signal to us that bearish sentiment is becoming elevated. And when it breaks below, it's generally a sign that markets may be becoming a little complacent.
Can I ask you this question? Who's the big buyers and sellers in this market? Is this you institutional people?
Yeah, fund.
This can't be Joe and Mary Lunchbucket out here.
No, it's fund managers. It's hedge fund traders, institutional traders, mutual fund managers that have the ability to use hedging strategies and options in portfolios. It's generally professional investors.
So there's probably almost none of the public represented in these lines here.
Very small, yeah.
Because I seem to be opposite of it all the time.
That's probably good because this is a contrarian indicator. All right, let's take a look at interest rates, right? What can the bond market tell us about helping to answer this question about the bull market? So if you're like me and you have CNBC on in your office in the background at all times, you probably have heard that all they can talk about recently is the 10-year yield hitting this 3% level, right? On and on and on, as if there's nothing else that really matters right now in the markets. But the 3% level in and of itself isn't any sort of magic line of demarcation, right? It's just another round figure. And when we look back, the last time that the bond market got up to this 3% level was in late 2013, early 14, when you see it was never able to get through it, right? So it hit resistance at that 3% level and came off of it. This time around, we're back at the 3% level. We think that it's likely that we do get above these levels because the economy is in better shape now, right? And so as the economy is firming, you would expect interest rates to kind of work their way higher to reflect that. So what would upset the market was if interest rates rose too fast. But if they rise in an orderly fashion, again, reflecting a stronger economy, then the market should be able to digest that fine. And as investors, we really would like to see rates inch a little bit higher because, again, that's confirmation that things are getting better in the economy. If rates continue to move lower, as investors, we would probably start worrying that, what's wrong with the economy, things are rolling over, that sort of thing. All right. What about inflation and its impact? The other thing is people say, well, the recent firming in inflation, does that mean that there's going to be an inflationary breakout, which is, usually not very good for stocks? So again, here's another long-term chart of the CPI index and also the Fed's favorite measure, the PCE deflator. And so what you see is recently the PCE deflator hit 1.8%. The Fed's goal that they've stated for years is to try to get inflation back to 2%. So we're not even there yet, right? So there hasn't really been a breakout in inflation. And again, as I just talked about how as investors we want to see a little bit of firming. The same thing applies here, right? So remember that in recent years, the Fed has expanded their balance sheet by $4 trillion, right, through these 3 rounds of quantitative easing. So the Fed went out there and did asset purchases to the tune of $4 billion with the single goal of getting some inflation, getting to this 2% target, right? Because central banks are very good at dealing with inflation. They just raise rates and get things to slow down. But what they don't have a good playbook for is dealing with deflation. Right, so all of these asset purchases that you've seen from the Fed, the Bank of Japan, the ECB, the Swiss National Bank, it's all aimed at avoiding deflation and getting some inflation going. So the fact that we're starting to see a little bit of firming in the inflation readings, again, should be viewed as a sigh of relief for investors, right? Because if the Fed had spent $4 trillion on asset purchases and inflation started to go the other way, we would have a lot bigger worries. Let's look at the yield curve. This is another big one, right? Investors say, or a lot of strategists are saying that since the yield curve is flattening, it's not going to be long before it's inverted, and then that's a signal that a recession is coming. So when we talk about the yield curve, what we're really talking about is the spread between the 10-year Treasury and the 2-year Treasury, right? So you can see that the yield curve has been flattening for several years now. Right now, the spread between the 10-year and the 2-year, as of last Friday, was about 48 basis points. Okay? So the bearish argument goes that once the spread gets below 50 basis points, it's not long before it gets down to 0, the yield curve inverts, and then you have to start looking for a recession. And the reason why people say that is that the last 5 recessions going back to 1980 were all preceded by an inverted yield curve, right? So it can be a useful indicator. The problem is it's not a very good timing tool, okay? So this is a long-term chart of that spread between the 10-year Treasury and the 2-year Treasury. And what we see here is, this was in 1984 when the spread broke, this dotted line is 50 basis points, right? That's where we are now at 50 basis points. And the solid line is 0. So that shows when the yield curve actually goes inverted, when it goes below 0. And what you can see here is back in 84, the yield curve got below this 50 basis points, but it was another 5 years before it actually got inverted, right? So it wasn't a very useful timing indicator. Again, in 1994, yield curve breaks below 50 basis points, but it's another 5 years before it actually gets inverted, right? So if you had exited the market in 94 and your clients didn't participate in the bull market of the 90s, it wouldn't have been a very useful tool to use. Even the last time around, the yield curve broke below 50 basis points in 05. There was another couple years of fairly good returns in the market before the onset of recession. So again, it's a useful tool in the big picture of things, but not, because lag times can be significant, it's not a great timing tool. This is the current chart of the Fed and the market expectations for the federal funds rate, right? That's the short-term rates that the Fed controls. And what you see here in the projections is that for the end of 2018, the Fed funds rate is expected to be at 2.13. At the end of 2019, it's expected to be at 2.88. So even if the 10-year Treasury stayed around this 3% level, give or take, it wouldn't be until 2020 that we actually saw an inverted yield curve. So again, there could be a significant lag time this time around as well. And as we talked about quantitative easing before, here's a chart of the quantitative easing that the Fed did, right? How they built up their balance sheet. Now, quantitative easing has come to the end, and we're on the other side of this money mountain, right? So we called this from quantitative easing to quantitative tightening. So if all this quantitative easing was aimed at helping keep interest rates low, it's reasonable to assume that on the other side of it, if the Fed is allowing these assets to roll off of their balance sheet, that all else being equal, that could exert some upward pressure on interest rates. And so if we do have any upward pressure, that would prolong, right, the slope of the yield curve before it actually gets inverted. Okay, and lastly, but probably most importantly, this is a chart of the credit markets, right? And specifically what we look at here is the spread between high yield bonds and risk-free treasuries, right? And what we're trying to gauge here is the stress or anxiety in the credit markets. Credit markets usually do a good job of leading the equity markets. So if there's signs of strain in the credit markets, not all stock investors pay attention, but they probably should, because historically it's been a good leading indicator. So what we can see is right now, there's almost no signs of strain in the high yield spreads, right? We're almost making new lows. As opposed to, in late 2014 and 2015, when you started to see the spread making higher highs, and this obviously preceded a big downturn in the equity markets. So right now, things are in pretty good shape. Back in 2014 and 15, remember, oil prices had a big plunge, and there was a lot of anxiety in high yield bonds in the energy market. Now we have oil prices firming to good levels, and there just really isn't a lot of signs of strain currently in these markets. Okay, so we've looked at a few different asset classes. Let's also look at the technicals, right? Because technicals can also do a good job of helping us a little bit in terms of answering this timing question. So here's a current snapshot of the S&P 500. The first thing that I would note from this chart is on top, this indicator that's on top, this is a relative strength indicator. And so what this looks at is the current overbought or oversold level of the market. When it gets up into this green area, it means that the market is overbought. When it gets down into the red area, it's oversold. And so what's interesting is in the beginning of this year, in late December, early July, you see that the market got severely overbought, almost to record levels up here. And so that was telling us that things, maybe the rubber band was getting a little bit too stretched, and it was probably time to pull in the reins a little bit. Coupled with that, you also had, as I mentioned, you had this, really low year of volatility in 2017. You also had 2 years since we'd had a 10% correction. So conditions were kind of set up, the market was overdue, and of course, we did have this big correction. What you'll notice is that it was almost textbook in terms of price action. The market came down and it perfectly tested, this red line is the 200-day moving average. So it tested the 200-day moving average and bounced from there, right? That's pretty normal. Then what you see is you have a pullback, the market bounces, and then usually at some time period after that, you'll have a retest of the lows. So the market came back down and had a retest of the lows. We would call this a successful retest in the sense that it didn't break down to new lows. So it held above the early February lows and then bounced again. Okay? So that to us is a pretty good sign. When you talk about corrections, you can really have two kinds of corrections. Everybody's used to the price correction, how much the market's pulling back, but you can also have a correction in the market in terms of time, right? And so sometimes the market needs to just pull back and work off an overbought condition and just spend some time consolidating and moving sideways. And we think that that probably is the most likely scenario that we're in now, that the market could spend some time oscillating in this trading range for a little while before ultimately being resolved to the upside. We also have the midterm elections coming up, which always brings about some uncertainty. So, we think that things are leaning towards being resolved to the upside, but investors likely have to exercise some patience maybe. And another positive factor about the recent pullback in the market was the dampening volatility that we saw. So this big spike here, right, that was when we had this first plunge down in the market. So you had a really big spike in volatility, but then on the retest and the most recent pullback, what we've seen is that the volatility index started making lower highs, right? So you saw volatility dampening as the S&P was doing these retests, and that's usually a good sign. You don't want to see fear continue to spike as you're expecting markets to calm down. Okay? The other thing is people say, we always talk about it's a red flag in a bull market when you start to see the market putting in lower highs. And so people have said to us, well, the market seems to be putting in lower highs now. That's what happened in 2007. Isn't it the same thing? So let's talk about some of the differences, right? Here's a chart of 2007 when the market peaked in October and then started putting in these lower highs. The reason why we think it's different this time is for a few different reasons. One is I just showed you that currently the S&P is doing a good job of holding above its 200-day moving average. In 2007, the market was struggling to this is the 200-day moving average. So you see the market was struggling to stay above the 200-day moving average then. So that was one bearish sign. The other difference is that in 2007 and late 2007, EPS growth or earnings growth had already started to roll over. Right? Right now, we're seeing the exact opposite, where earnings growth is just starting to accelerate. And for the next few quarters, earnings growth is expected to come in above 20%. Okay? A third difference that we just talked about are signs of strain in the credit market. Right? So right now, we don't see any strains in the credit market. High yield spreads are extremely low. In 2007, we were already starting to see signs of cracks in the high yield market. There was, high yield spreads were rising. The housing market had already peaked. Remember, there were those two Bear Stearns hedge funds that had already blown up. So there was already some signs of strains coming out of the credit markets that we don't have today. And the last factor is the yield curve inversion, right? We just talked about how the yield curve is still positive and there could be a significant lag time. By this time in 2007, the yield curve had already inverted. So you had a number of other red flags that were showing up in addition to the price action in the market. So that's why we think that this time around there is enough differences that the comparison doesn't really hold. Okay, and with that, I'm going to leave it with a quote. This is a quote from a famous investor, John Templeton, who said that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. right? So the question is where are we now? So I would probably argue that maybe we've seen a little bit of optimism so far, like during that January rally, but I don't really think that we've seen signs of euphoria yet, right? And so it doesn't mean that 100% that we have to get into this euphoria stage before all is said and done, but most bull markets do exhibit some signs of euphoria before they eventually come to an end. So it's just something to keep in mind and watch for. Okay, and with that, if there's any other questions, happy to take them. Yeah.
Two, one on this euphoria and earnings thing, that the market's very reasonable based on current projected earnings. Do you have any commentary on the cyclically adjusted PE ratio? That's one question. The other one is, why do we need inflation at 2%? Why don't they shoot for zero? Why don't they shoot for keeping our dollar stable?
Okay, so the first question, I tend to not follow the cyclically adjusted ones as well. Most portfolio managers really are looking at the forward estimates as a better indicator and just showing more sensitivity. The cyclically adjusted ones, right, they're looking at past earnings. For me, it just tends to be a much more academic way of looking at it, and I don't think that if you looked historically at using that to help you as an investor, it didn't do a good job of keeping you in bull markets and getting you out of bear markets. It really would have kept you out of a lot of strong markets going by the Cape, in my opinion. And then in terms of the inflation, it really comes down to deflation. The way that our economy is built and everything is for there to be increases in asset prices, right? That's what gets people to invest and be bullish on things and spend money on CapEx and, to look for growth. So to be at zero really would mean that asset prices stay flat, and there wouldn't really be that incentive for participants in the economy, to expect growth and spend for growth and all that sort of thing. So that's why the Fed always wants to see a little bit of inflation to keep things growing, but not to get out of hand and get overheated. Targeting zero would probably be too much of a concern for them, that too close to deflation. And what happens in deflation, like with Japan, right, they had a lost decade, because if you expect that asset prices are going to continually go down, then there's no reason to do anything today. You might as well just delay all of your purchases and all of your investments until you think prices have bottomed. Okay. Any other questions? Yes.
Latest forecast for the debt, U.S. debt servicing is going to be, soon it will be more than the military budget. So I see Fed should be tightening, as you mentioned. So is global central bank, likewise, deleveraging. Wouldn't that have tremendous impacts to us, market crashing?
Well, I don't know if it would have an impact on the market crashing. Longer term, it should be a concern, right, that the budget deficits are getting so high that, as you said, the debt service will start to crowd out other forms of government spending. But as you look at, people have been saying that for decades, right, and it's really never come to fruition. And as we look at other developed countries, there's a lot of other countries who have a much higher debt to GDP than the US does. And so I guess what I'd be watching for is to see if it starts with other countries first, right? Does the bond market start looking at a day of reckoning for any of these other companies, right? At what point does the bond market say, we're tired of financing all these deficits and now the costs are going to go up? So I do think that it's a longer term concern structurally for our economy, but in terms of today's things and helping to time this market, I don't think it's an issue for this cycle. Let me get one in the back here. Yes?
Jordan, so how do you personally feel the market next year to 2 years?
Yeah, so I personally am leaning bullish, right? I think that ultimately the strength of the earnings growth that we're seeing, that is ultimately the strongest driver of stock prices. There's enough bearish sentiment that the wall of worry is there, credit markets are calm, and so ultimately I think that after we can get through this period of digestion, through this correction, that things are going to be resolved to the upside. I think we could get a little bit more multiple expansion, in terms of looking at next year's earnings. So I think that there's more upside before, before we have to start looking towards when this bull market may have come to an end.
Your chart on the oversold, how is that determined if the market's oversold or underbought?
It's looking at, it looks at market breadth, right? The number of advancing issues versus declining issues, the volume on advancing issues during declining issues. So it's an oscillator that's always moving back and forth. And when there is sustained, tremendous buying pressure, much more than there is selling pressure, it causes that RSI index to move higher. And since it's an oscillator, right, it can only stay high for a certain amount of time before it starts to come back down. Yeah.
What are your thoughts on this being the beginning of a 2-year, or the beginning 2 years of a bull market? Being that in 2015, you had a large number of companies being down 20%, biotech, energy names being down 30, 40%. London is just getting out of what it was a bear market. And
Yeah.
markets are now rising, oil is rising.
Yeah, I mean, it's funny, there's a lot of different definitions for what people characterize as bear markets, and the media seems to change it all the time, right? And so stocks being down or certain sectors being down 20% doesn't really classify as a bear market. What was interesting about the last pullback that you're talking about in early 2016 was that it was more of a rolling correction, right? So while you had different sectors that did experience 20% declines, you never had the overall market down 20%, So if you look at it, it really was more of kind of maybe a mid to late cycle pullback and digestion period, where you had this 10 to 15% pullback in the market, but it didn't really have the full onset of bearish conditions. A true bear market, it's not just the 20% pullback. You also start to see economic growth contracting. You start to see earnings growth rolling over. And so you didn't have these other factors that generally would fit the definition of a true bear market. Okay.
In your inflow-outflow chart,
Yeah.
when they are all outflow, does it automatically assume to go to like money market, or does it go to alternative investment?
No, well, in general, it usually goes to money markets. That's what we saw during the last financial crisis, that there was, I think it got like $7 trillion was just sitting in money markets. And so that's when people are just really fearful. They just pull out of everything.
So how much?
I don't know. It's come down a little bit, but not as much as you would have expected given how long we've been in this cycle. There still are trillions of dollars sitting in money market. There's a lot of people that after 2008 just thought, you know what, I'm just going to sit. And so they never really got back in. So it's something that strategists have talked about, if the market does continue to make new highs at some point, does that start to drag in some of that money off the sidelines? But we haven't seen a ton of it yet. But there's been a lot of money that's flowed into bond funds over the years. All right. Do we have time for more, Frank? You want me to? Okay.
What's your thoughts on how wage inflation or the demographics of the baby boomers retiring and unemployment being so low and workers, a shortage of workers going out there and possible wage inflation? What's your thoughts on that happening soon and slowing the economy down?
Yeah, I mean, what's interesting is that after the financial crisis and that recession, you had a lot of people that actually left the workforce, right? So when they look at the labor participation rate, we've seen that was actually hitting some multi-decade lows. And so I think the wild card again is the millennial generation, right? That there is a large pool of available workers. It's been a little slow with them getting back into the labor force and bringing that number up again. So I think that there probably is a pool of available workers out there that hasn't really worked its way into the statistics yet. So I'm a little less concerned about the overall worries in that.
How do you feel the change in the tax rates and the lowering of corporate and personal income tax rates and subsequently the repatriation of capital from abroad, how that will impact the economy going forward?
Yeah, so I didn't really talk about that in here, but it's another, I think, huge driver and a huge tailwind for the economy, at least in the near term. I mean, the tax cuts, right? Individuals are just starting to see the benefits of the tax cuts, having just passed the April 15th tax deadline. And so I think that could change some spending plans of individuals and small businesses going forward. But the other big thing that you mentioned is we've already seen repatriations and dividend announcements, or dividend and buyback announcements from repatriations just hitting record levels, right? I mean, Apple alone is expected to bring back $245 billion. And so while some of these companies have tried to have politically correct sound bites and say that they're going to do more capital spending and pay their workers more, we know that the investor class is probably going to benefit the most. And so dividends and buybacks is going to be a huge thing this year. And we're just starting to see it. This quarter, listening to conference calls, and we're still in the middle of earnings seasons, we've just started to hear managements discuss increasing this dividend and buyback activity. So I think it's going to be a continued tailwind for the remainder of this year.
That 245 and others like that, is that just going from money market someplace else, money market here, or is it buybacks, dividends, or is it reinvesting? And what are they typically doing?
So first, right, yeah, it's sitting in short-term deposits abroad. So the first thing is bringing it back to the U.S. And the interesting thing in the case of Apple, I haven't heard about every other company, but the taxes that are due on it, Apple was able to stretch those out, I believe, over 8 or 10 years. So it's even more favorable in terms of their cash flow. But, right, so the investors know how much cash is sitting on the balance sheets of all these companies, and they're going to exert pressure on them that, you know, a company like Apple or Microsoft or a lot of the pharmaceutical, they just have way more cash than they need. So if they're not planning any big acquisitions, you know, return it to shareholders. And so in addition to increasing dividends and things like that, what I think you'll also see some of, and we saw Microsoft do this in the past, are some one-time, you know, some one-time special dividends that get paid just to give people back a chunk of investors, a chunk of this money in one fell swoop.
How do you see the impact of potential trade war, where it may impact the dollar devaluation?
You know, it's really hard to figure out. Obviously, a trade war wouldn't be beneficial for the economy, but I don't know. I feel like at the end of the day, most of the people that are involved in these things understand that, and right now, it's more being used for negotiating tactics than anything. You know, a full-blown trade war obviously would change the outlook for things, but it's not something that I currently am really factoring in right now. And even like the current, you know, bout with China, when we looked at the potential impact from the tariffs that have been announced, you know, I think it was 0.5% of GDP. So it's not really big numbers that are being talked about right now. It's really more just conceptually and, as I said, you know, leverage for bargaining power.
We'll take the last question.
All right, last question.
Investment in infrastructure. We hear about how the United States infrastructure within the next decade, you know, looking at about $1 trillion investments. Where does that kind of fit on as a sector to look at potential opportunities?
So most of it would come from government spending, right? I mean, that's the thing that Trump was talking about recently, was passing this infrastructure bill, and you know, the economists were complaining that usually a big infrastructure bill is something that you pass in coming out of a recession in the beginning of a recovery to help boost the economy. It's not something that you really do at late stages when people are already talking about inflation moving higher and stuff. So it's not the best timing of doing one right now, but in terms of sectors and things, you know, you probably would look to companies that would be awarded these contracts. So a lot of the big engineering and construction firms, they would probably be big beneficiaries of it, stuff like that. People that help with energy infrastructure, those type of firms and those type of sectors. Okay?
Thank you.
Thank you very much.